Welcome, curious minds, to another deep dive. Have you ever wondered how we can, truly trust the numbers a business puts out into the world? It's such a fundamental question, isn't it? It underpins so much of our economy and, well, how we make decisions. Whether you're an investor thinking about joining a company or maybe just trying to make sense of the financial headlines.
It's a critical question indeed, a really critical one, and it's precisely what we're diving into today. Our focus is on something called sufficient appropriate evidence in the world of auditing. Now, I know it might sound a bit technical, maybe even dry, but at its heart, it's really the bedrock of financial trust. It ensures that the conclusions auditors draw about a company's financial health are sound, reliable, and truly reflect reality.
Okay, let's unpack this then. We've got some really fascinating source material here that lays out exactly what audit evidence is, why it's so vital, and maybe some of the surprising challenges auditors face in getting it right. Think of it as like peeking behind the curtain, seeing how financial statements actually get their stamp of approval. It's definitely not just about crunching numbers. It's more like a rigorous, methodical search for truth. The auditor acting like a kind of financial detective, piecing together clues to form a clear and trustworthy picture.
Absolutely. And our mission today is really to walk you through this concept step by step. We want to explain every part in detail so you can grasp not just what it is, but maybe more importantly, why it matters. And perhaps you'll even spot some aha moments along the way. See how these seemingly abstract financial processes connect to real-world reliability and even the stability of our markets, really. We'll be looking closely at how auditors build a persuasive case for their opinions, much like a meticulous craftsman building a really durable structure.
Okay, I'm ready. So get ready, everyone, to discover this fascinating world where skepticism meets data, and where every piece of information, every confirmation, every observation holds a potential key to understanding the true financial story.
What exactly is audit evidence, the foundation of trust?
Right. So to start, let's lay the groundwork. What exactly is audit evidence? It sounds like something straight out of a detective novel, maybe, like a stack of incriminating documents. But you're saying it's broader than that.
It is. It really is. At
Yeah.
its core, audit evidence is essentially all the information an auditor uses to form the conclusions on which their audit opinion is based.
Mhm.
And I mean all information. This isn't just about reviewing spreadsheets or, examining paper trails. It's an incredibly comprehensive net. So, for instance, if a company claims it has, say, $10 million in cash,
Okay.
the auditor needs more than just the company's internal ledger showing that balance. That's just the starting point. They'll want to see external bank statements, maybe get confirmations directly from the bank.
Right. Go outside the company.
Exactly. And potentially even observe the internal process for handling cash, see how it works in practice. The crucial part, the defining part really, is that this information must be obtained specifically to support the auditor's conclusions. It's the raw material for their final judgment, providing the backing for every claim they make about a company's financial health.
That makes perfect sense. So it's about building a really solid case piece by piece. But when does this financial detective gather all this information? Is it like a big data dump at the end of the year, or is it more um, spread out?
That's a great question. And what's truly fascinating here is that evidence gathering is an ongoing, dynamic process. It takes place throughout the entire audit engagement, right from the initial planning stages all the way to the final review. It's definitely not a single, isolated event. It's much more of a continuous effort that helps auditors build a complete and, importantly, evolving picture of the company. Think of it like a detective building a case, right? They don't just collect evidence at the scene of the crime and stop. They gather new clues as the investigation unfolds, adjusting their approach based on what they find. Specifically, evidence is gathered when auditors perform various crucial phases. First, there are risk assessment procedures. This is where the auditor first tries to get a really deep understanding of the client and its environment. They're looking for areas where the financial statements might be most vulnerable to misstatement, either due to, simple errors or even potential fraud.
So like weak spots.
Precisely, weak spots. Evidence here might include things like interviewing management about their business strategy, reviewing industry reports to understand market trends, or analyzing the company's internal organizational structure. It helps the auditor focus their efforts where the risks seem highest. Then you have tests of controls. So once the auditor understands the risks, they check if the company's own internal systems, the policies and procedures designed to prevent, detect, and correct errors, are actually working as they're supposed to.
Okay. Checking the company's homework, kind of.
You could put it that way, yeah. For example, an auditor might observe an employee processing a sales transaction to see if they follow the correct authorization steps. Or they might review a sample of expense reports to check if all the necessary approvals were obtained. The evidence from these tests helps them figure out how much they can actually rely on the company's own internal systems. Next up are substantive procedures. Now, these are the direct, detailed tests of the financial numbers themselves. This is often where, the rubber meets the road.
Digging.
The real digging, exactly. This could involve sending confirmations to external parties, like customers, asking them to verify outstanding balances they owe the company. It might also involve examining specific high-value transactions in detail or performing analytical reviews to identify unusual trends or significant fluctuations in financial data that just don't look right. And finally, there are other audit procedures. This is really a sort of a comprehensive catch-all for anything else needed that doesn't fit neatly into those first three categories. It just ensures no stone is left unturned in forming that comprehensive picture. It really underscores the flexibility and the thoroughness required in a proper audit.
So it's this continuous evolving process then. And where does this evidence actually come from? Are auditors just looking at the company's internal stuff, like their balance sheets and income statements, or do they need to reach out beyond the company's own walls?
That's the key distinction. While internal records are, of course, a very big and necessary part of the audit,
Right, you have to start there.
you have to start there. But the evidence can, and often must, also come from other significant sources. These provide valuable context or, crucially, independent verification that internal records alone just can't offer. This multi-source approach dramatically enhances the overall reliability and, frankly, the credibility of the audit. So these other sources include previous audits. Auditors can gain really critical insights from looking at prior years' examinations of the same client. This historical knowledge helps them understand recurring issues, maybe the effectiveness of controls over time, and the consistency, or lack thereof, of financial reporting practices.
Like checking the case history.
It's exactly like checking the case history. It provides a baseline and context for the current audit period, spotting patterns, learning about habits. Another important source is a firm's quality control procedures, specifically those related to client acceptance and continuance. Before an audit firm even takes on a new client or decides to continue working with an existing one, they have these rigorous internal procedures. They assess things like the client's management integrity, the firm's own competence to actually perform the audit well, and any potential conflicts of interest.
Ah, so they audit the client before they audit the client.
In a way, yes. The information gathered during these initial assessments, things like background checks on key management or evaluations of the industry they operate in, that itself becomes a form of audit evidence. It helps prevent auditors from getting into situations where obtaining sufficient appropriate evidence might be compromised right from the start. It basically ensures the audit firm is actually fit to take on the case, as you put it.
That really highlights that auditing isn't done in a vacuum, does it? It clearly benefits from that historical knowledge and also having robust internal processes within the audit firm itself. It's not just about a snapshot in time, but like a continuous relationship built on trust and rigorous self-assessment. Almost like the audit firm needs to be sure they can do the job properly before they even start looking at the client's numbers.
The core components and forms of audit evidence.
Okay, so we've established what audit evidence is, generally when and where it's gathered throughout the whole audit process. Now, let's zoom in a bit. Let's talk about the actual stuff the auditor is looking at. Our source material mentions underlying accounting records and then corroborating or contradictory evidence. What's the fundamental difference between those two? And why does that distinction matter so much for an auditor who's trying to establish financial trust?
That's a fantastic, really intuitive question. And it gets right to the heart of why auditing exists beyond simply, ticking and tying a company's books. The distinction is absolutely crucial for evaluating the overall reliability of the financial statements. You can think of it like this. The company creates its own story about its financial activities through its accounting records, right?
Their version of events.
Their version. The auditor then seeks out corroborating evidence to confirm if that story lines up with reality, or, and this is important, if there's contradictory evidence that challenges it. So let's start with 2.1 accounting records. The books and beyond. These are the foundational documents of a business, the records of initial entries and all their supporting detail. They are, in essence, the company's direct internal narrative of its financial life.
The raw ingredients.
The raw ingredients, exactly, or the basic blueprint of every financial transaction. It's what the company says happened internally. So, for example, accounting records include things like checks and records of electronic fund transfers, Direct proof of cash going out or coming in, records showing money paid to a supplier or received from a customer. Invoices, both sales invoices, detailing what the company billed its customers, and vendor invoices, detailing what the company was billed by its suppliers. They provide specifics, quantities, prices, terms, contracts. These define the terms of agreements with customers, suppliers, employees. They significantly impact how revenue is recognized, when expenses are incurred, what liabilities might exist. Really important stuff.
The fine print.
The fine print, absolutely. Then you've got ledgers and journal entries. These are the organized compilations of all the financial transactions. Journal entries are the initial chronological records, and ledgers then categorize these into specific accounts like cash, accounts receivable, sales revenue. They show the organized flow. And even things like internal worksheets. These could be detailed calculations, maybe reconciliations like a bank rec to match the company's cash balance with the bank's records, or summaries that support entries in the formal ledgers. These are all the direct traces of transactions as recorded by the company itself. Now, auditors test these accounting records through various procedures. For instance, they use analytical procedures. That means looking for patterns or anomalies, maybe comparing current year expenses to prior years or to industry averages to spot unusual fluctuations that need a closer look.
Things that stick out.
Things that stick out, yeah. And they also perform substantive procedures, which involve more detailed checks. This could include retracing procedural steps, which means following a specific transaction, like a sale, right from beginning maybe the customer order all the way to its final recording in the financial statements.
Following the trail.
Following the trail. Another example is recalculation, where the auditor independently checks the math. Simple but crucial. Recalculating depreciation on assets, or checking the arithmetic on a payroll register. And then there's reconciliation, which involves matching numbers from different sources, like making sure the cash balance in the company's general ledger actually matches the bank statement.
Okay, here's where it gets really interesting for me. Our source states very clearly that accounting records alone do not provide sufficient support for the audit opinion. Why is that? I mean, if they're the direct records of what the company did, shouldn't they be enough? Why can't an auditor just rely solely on the company's own books? It seems like the most direct source.
This is such a critical point, and it really underpins the entire audit process. It's often an aha moment, because it highlights that fundamental need for independence. While accounting records are absolutely the indispensable basis of the financial statements, you can't do an audit without them. By themselves, they could be incomplete, they could be manipulated, sadly, in cases of fraud, or they could simply contain unintentional errors.
Human error, system glitches.
Exactly. They tell you what happened according to the company's internal books, but they don't necessarily confirm if that accurately reflects reality outside the company's control. Imagine, like, a company claims to have sold a huge batch of products. Their internal accounting records would show the sale, the invoice, the entry in the sales ledger. Looks fine on paper.
Right.
But what if the customer never actually received the goods? Or what if the customer is actually a related party, maybe another company owned by the same people, just making a fake order to boost sales figures?
Ah, okay. The internal records wouldn't show that side.
Precisely. The internal records wouldn't necessarily tell you that. So the auditor's job is fundamentally to go beyond what the company presents internally and seek independent verification. It's the company's narrative, sure, but an auditor needs that objective external lens to validate it. However, it is important to note, as the source does, that when there's strong internal consistency among the accounting records themselves, for example, if the general ledger ties neatly to the subledgers and everything balances correctly within the system, that does provide some level of evidence. It suggests a cohesive and generally functional system within the company, but it's still only one piece of a much larger puzzle.
Okay, so if the accounting records aren't enough on their own, that's where this corroborating evidence comes in, right? It's like the witnesses who back up the story. Or maybe provide alternative perspectives, either confirming or, I guess, challenging the initial account the company presents.
Precisely. You've got it. 2.2 Corroborating evidence. The supporting cast, as the outline calls it, provides that essential additional support. It gives validity to the recorded accounting data. It helps to confirm, or sometimes importantly refute, what the accounting records suggest. It's all about looking at external or independent sources to see if they align with the company's narrative. Essentially, getting a second, objective opinion. Some examples include minutes of meetings. These can confirm significant management decisions that impact financial reporting. Things like the approval of a major asset purchase, maybe a new loan agreement, or changes in key accounting policies. Reviewing these provides context and verification.
Proof they actually decided to do it.
Proof they decided it, and when, and maybe why. Then, confirmations from external parties. This is one of the most crucial forms of corroborating evidence, hugely important. Auditors often send direct requests to third parties, like asking banks to confirm cash balances or loan details, asking customers to confirm outstanding accounts receivable, the money they owe the company.
Directly to the source.
Directly to the source. Or asking vendors to confirm accounts payable, the money the company owes them. These independent confirmations are highly reliable because they come directly from an unbiased external source, completely bypassing the client. Other examples: industry analyst reports. These offer external, often expert views on the company's performance, its industry, broader market conditions, provides valuable context to assess if the company's results seem reasonable. Data about competitors. Understanding how competitors are doing their revenue growth, profitability can provide context for the client's own results and help spot unusual variances that need digging into.
Like a reality check.
A reality check, absolutely. Also, evidence obtained from management specialists. Sometimes a company relies on its own external specialists. Think actuaries for valuing complex pension obligations or engineers for assessing the useful life of specialized assets. The auditor needs to get evidence to confirm the competence, the capabilities, the objectivity of these specialists, and critically, the appropriateness of their work and the assumptions they used. The auditor isn't just taking their word for it.
They check the checker.
You check the checker, in a sense, yes. And finally, information obtained directly through observation, inquiry, and inspection. These are really hands-on techniques auditors use. Observation might involve, say, watching the company's employees physically counting inventory in a warehouse to make sure they're following the correct procedures.
Seeing it happen.
Seeing it happen. Inquiry involves asking lots of questions of management and employees about specific processes, transactions, or account balances. And inspection means physically examining original documents like contracts, loan agreements, title deeds to property, or physically inspecting assets, like looking at a large piece of machinery listed on the balance sheet to confirm it actually exists and seems operational. This type of corroborating evidence provides a really vital independent layer of verification. It significantly reduces the risk of bias that could be present if you only looked at the company's own internal records. It's how the auditor pieces together the full, credible story, not just the version presented by the company.
Right. Now, in today's world, everything's going digital, isn't it? Our source points out that some evidence might only be available electronically. How does that change things for an auditor? It sounds like it could introduce a whole new set of complexities and challenges compared to, say, a physical paper invoice you can hold in your hand.
You're absolutely right. And this brings us to 2.3 evidence in electronic form, the digital frontier. And it is a significant modern challenge for auditors. It's really reshaping how we think about evidence. In many companies today, traditional source documents, paper invoices, paper purchase orders are completely replaced by electronic messages. Whole business processes are transacted electronically from start to finish.
Clicking buttons instead of signing papers.
Exactly. Think of fully paperless transactions, cloud-based accounting systems, e-commerce platforms where orders, invoices, payments happen instantaneously and entirely digitally. Now, the key issue here, the real challenge, is that while this electronic evidence might be initially available, it might not be retrievable indefinitely.
It can disappear.
It can? This could be due to rapid system changes, maybe company data retention policies that automatically purge older data after a certain period, maybe after just a year or two, or even technical issues like data corruption or system crashes. Unlike a physical invoice that, once printed, generally exists until someone physically destroys it, electronic data can be much more ephemeral, much harder to preserve over the long term. So therefore, the auditor must consider the time during which this information exists or is available. They have to think about that when determining the nature, the extent, and the timing of their auditing procedures.
So they might need to grab it sooner.
They might need to grab it much sooner, exactly, much earlier in the audit process than they would for paper documents. Or they might need to implement specific proactive procedures to ensure the integrity, the completeness, and the accessibility of that digital data for the whole duration of the audit, and maybe even afterwards for regulatory reasons. They might need specialized software tools, data analytics tools, to access and analyze huge data sets. Or they might need to work really closely with the client's IT specialist to understand their data retention policies, their system security, the data lineage, where the data comes from and how it flows. This shift to digital evidence fundamentally impacts audit planning. It requires auditors to develop new skills, new tools to handle digital information effectively, making sure it stays reliable and available throughout the audit cycle. It's kind of a continuous race, really, to keep up with the technological advancements in how businesses record their information.
The pillars of trust, sufficiency, and appropriateness.
Okay, this feels like we're getting to the real core of it now, the heart of our deep dive. Sufficient and appropriate evidence. It sounds like it's not just about having some evidence, but the right amount and the right kind. They sound similar, but you're saying they're distinct. Let's unpack what those terms really mean.
That's a really perceptive observation because these two concepts, sufficiency and appropriateness, are absolutely foundational. You can't have a reliable audit opinion without both. An auditor isn't just, checking boxes or collecting a big pile of documents. They're building a persuasive case. And that case needs both enough material that's sufficiency and the right kind of material that's appropriateness to be credible and to withstand scrutiny. Let's first talk about 3.1 reasonable bases for an opinion. More than just a guess. The ultimate goal, the whole point of gathering audit evidence, is to persuade the auditor that the financial statements, taken as a whole, are fairly presented. Now, the audit provides what we call reasonable assurance regarding the fairness of those financial statements. This is a very important distinction for you to grasp. The auditor is not a guarantor. They do not provide absolute certainty.
Okay, so reasonable assurance, not absolute certainty. That might sound a bit surprising for something as critical as financial trust, it sounds like. Not quite 100%. Why isn't it an absolute guarantee? Is it because auditors just don't check absolutely everything, like every single transaction down to the last penny? It seems like to be truly certain, you'd have to look at everything.
Exactly. You've hit on a core practical limitation, and this is often a key aha moment for understanding what an audit actually is and what it isn't. In most cases, simple cost-benefit considerations prohibit an examination of 100% of the accounting data. Just imagine trying to audit a massive multi-billion-dollar company that processes millions, maybe tens of millions of transactions every single day.
Impossible.
It's simply not practical, it's not economically feasible, and frankly, it's not even humanly possible to scrutinize every single one down to the penny. Therefore, it is generally not practical or possible to obtain assurance beyond all doubt. So the auditor usually must rely on evidence that is persuasive rather than absolutely conclusive. Think of it like a giant jigsaw puzzle with maybe thousands or tens of thousands of pieces. The auditor doesn't necessarily need to put every single piece perfectly in place to see the clear picture, right? They need enough key pieces placed strategically in the right spots to be confident about what the overall picture looks like. Now, persuasiveness, that's a bit of a subjective concept, isn't it? It's unique to each audit engagement. And it's really about reaching a point where the weight of the evidence is compelling enough to support a conclusion without requiring that absolute unattainable certainty. It's influenced by the nature of the evidence, what kind is it, the extent how much is there, and the timing, when was it gathered. It's about building a strong enough case that another reasonable, objective professional looking at the same evidence would likely reach the same conclusion. Now, a crucial ethical point here, which our source highlights very clearly. While that cost-benefit relationship might be a valid reason for choosing which procedures to perform, or maybe testing a sample instead of the whole population, cost alone, or just the difficulty in obtaining evidence, is not a valid basis for omitting a necessary procedure if there is no appropriate alternative way to get that assurance.
So you can't just say it's too hard.
You can't just say it's too hard or it's too expensive if that evidence is vital to forming the opinion and there's no other way to get the same level of comfort. This really underscores the auditor's professional responsibility to the public. They have a duty to provide a credible and robust opinion even when faced with practical challenges. Judgment is key.
That makes perfect sense. A duty to the truth, not just to efficiency. Okay, so moving from that idea of reasonable basis to the specifics, let's talk about 3.2 sufficiency. Quantity matters. Does this just mean the more evidence the better, pile it high? Or is there a more nuanced way an auditor decides how much evidence is actually enough?
Right. Sufficiency refers specifically to the quantity of audit evidence obtained. How much do you need? And it's definitely not just about accumulating a massive pile of documents for the sake of it. It's about having enough appropriate evidence to properly support the audit opinion on the financial statements as a whole. The auditor has to use professional judgment in determining the amount and the kinds of evidence that are sufficient to support that opinion. And this determination is deeply influenced by two key factors we've touched on. Materiality. Remember, materiality is about the significance of an error or misstatement. Could it reasonably influence the decisions of someone reading the financial statements?
Like, would it change an investor's mind?
Exactly. Auditors focus more evidence naturally on areas where potential errors would be material, where they could really matter. The second factor is audit risk. This is the risk that the auditor might unknowingly give a clean opinion when the financial statements are, in fact, materially misstated. Auditors aim to keep this risk acceptably low. Now, the amount of evidence gathered directly affects the level of detection risk. Detection risk is the risk that the auditor's own procedures won't detect a material misstatement that actually exists in the company's books.
The risk of the auditor missing something important.
Precisely. Think of it like a security guard patrolling a large warehouse. If they only check one door every hour, their detection risk for a break-in is pretty high, isn't it? A lot could go wrong unnoticed between checks. But if they check every single door every 5 minutes, their detection risk goes way down. Similarly, in auditing, the more thorough our checks, the more evidence we gather for a particular account or assertion, the less likely we are to miss a significant problem. More evidence generally means lower detection risk. The auditor's decision regarding the sufficiency of evidence is also influenced by the risk of material misstatement. If the auditor assesses a greater risk right from the start, maybe the company's in a really volatile industry, or it has super complex transactions, or its internal controls are known to be weak, then more evidence will be required to mitigate that higher inherent risk. You need to dig deeper where there's more smoke, basically.
Makes sense.
And also the quality of audit evidence. And this is where it ties directly into our next big topic, appropriateness. Less audit evidence might be required when the evidence you do get is of higher quality. If you have a perfectly clear, independently confirmed document from a highly reliable source, you might not need quite as many pieces of evidence as you would if you were relying mostly on, say, less reliable internal estimations for the company. So quality can sometimes compensate for quantity, at least to a certain degree.
Okay, so back to quantity for a sec. If I found overwhelming, totally irrefutable evidence for just a tiny insignificant part of the financial statement, say a single $500 account receivable, is that enough? Our source has a great example about exactly that.
That raises such an important question, and it perfectly illustrates the concept of sufficiency. Even if evidence is absolutely conclusive, rock solid, for a small portion of a balance or just a single transaction, it's generally insufficient to support the entire balance. For instance, the source notes, overwhelming evidence that a $500 account receivable exists does not in any way substantiate a total accounts receivable balance of, say, $1 million.
Right, it doesn't scale up.
It doesn't scale up. It's like trying to audit a whole forest by meticulously examining just one single tree. While that one tree might be perfectly healthy and sound, it tells you very, very little about the overall health, the size, or the species composition of the rest of the forest, does it?
Not really, no.
The auditor needs evidence that is proportionate and provides adequate coverage across the entire financial statement item being tested. It's about building a picture of the whole forest, not just getting really familiar with one leaf. And this brings us perfectly to 3.3, appropriateness. Quality and relevance are key. While sufficiency was about quantity, having enough evidence, appropriateness is all about the quality of that audit evidence. Appropriate audit evidence must be both reliable and relevant. Reliability speaks to the trustworthiness of the information, can you depend on it, and relevance speaks to whether it actually addresses the specific assertion or risk the auditor is trying to test, does it hit the target? And remember, the auditor must consider whether the information corroborates, supports, or contradicts, goes against the financial statement assertions. Both types of information are evidence, and both must be taken into account to get that full, unbiased picture. The appropriateness of evidence depends heavily on its source and on key attributes like its accuracy, its completeness, its authenticity, and importantly, its susceptibility to management bias.
Okay, reliability is clearly crucial then. Quality matters. Our source outlines a really helpful hierarchy of audit evidence, ranking it from most reliable down to least reliable. What's at the absolute top of that hierarchy? What's the gold standard for auditors?
This is a fantastic passkey from the source material to remember, and it's such a vital concept for understanding evidence quality. Reliability is highly dependent on the specific circumstances under which the evidence is gathered, and crucially, on its source and its nature. When evaluating reliability, the auditor is always considering, is this information sufficiently detailed for my purpose? And have I obtained evidence regarding its completeness and its accuracy? So let's break down this hierarchy of reliability, moving from the most reliable down to the least reliable. Number 1, auditors' direct personal knowledge. This is the absolute gold standard, the top tier. This means evidence obtained directly by the auditor through their own efforts.
Seeing is believing.
Seeing is believing, exactly, or doing is believing. So, for example, if an auditor physically observes inventory being counted in a warehouse, or if they physically inspect a large, expensive piece of machinery listed on the company's books to see it's there and looks okay, or if they reperform a calculation themselves, like recalculating the interest expense on a loan agreement, this provides the most persuasive evidence because the auditor has firsthand experience. They directly control the process of obtaining it, and they can immediately assess its accuracy and authenticity. There's no intermediary involved who could introduce error or bias. It's like seeing something with your own eyes, as you said. Number 2, external evidence. This type of evidence is obtained from independent sources outside the enterprise being audited. This provides a greater assurance of reliability compared to internal evidence simply because it's less susceptible to management bias or manipulation. It's information coming from a third party with, presumably, no vested interest in how the financial statements look.
Like the bank example earlier.
Like the bank example, exactly. And there are two main types of external evidence. Evidence sent directly to the auditor. This is the most valid and reliable type of external evidence. The classic example is that bank confirmation, where the auditor directly requests the bank to confirm the client's account balance, maybe outstanding loans or other financial arrangements. This information is highly reliable because it bypasses the client entirely and comes straight from an independent financial institution. Then there's evidence received and held by the client. This would be something like an original vendor invoice or a customer purchase order that the client received first and then filed. While it's still external in origin, it came from outside, the auditor needs to exercise a bit more caution and verify its authenticity. Why? Because it has been in the client's possession, so it could potentially have been altered or maybe it's incomplete. The auditor might compare it to related shipping documents or payment records to verify it. Now, there's an important nuance here. Information obtained from management specialists like that actuary hired by the company for pension valuations, or even an auditor's own specialist, an expert hired by the audit firm, maybe to value complex financial instrument that information is not considered to be from an external source in the same way as, say, a bank confirmation.
Oh, interesting. Why not?
It's due to the professional relationship created by the terms of the engagement. They're engaged by either the client or the auditor. So the auditor still needs to rigorously evaluate the specialist's work, their assumptions, their objectivity to ensure it's reliable for audit purposes. It doesn't get the automatic high reliability score of a truly independent third party like a bank. Number 3, internal evidence. This refers to information generated within the enterprise itself. This includes all those documents we talked about earlier, purchase orders issued by the company, sales orders, internal general ledgers, management reports. While absolutely essential for understanding a company's operations and financial reporting, internal evidence is generally considered not as reliable as external evidence when taken on its own.
Because it's from the company itself.
Exactly. Because it's created and controlled by the entity whose financial statements are being audited, it inherently carries a higher risk of potential bias or unintentional error. However, and this is a big however, its reliability is significantly improved by strong, effective internal controls. If a company has robust systems and controls in place to ensure accuracy, proper authorization, prevent fraud, and so on, then the internal evidence generated by those systems becomes far more trustworthy. For example, an internal sales invoice generated automatically from a secure sales system with proper access controls is much more reliable than one manually typed up with no checks. Number 4, oral evidence. This is generally considered the least reliable form of evidence. It consists of statements made by clients' management, employees often explaining account balances, procedures, or providing context for transactions. Now, while it's an absolutely necessary part of the audit process, auditors have to ask questions to understand things. Oral evidence is highly susceptible to being misremembered, maybe misinterpreted, or even intentionally biased.
People forget, or maybe they have an agenda.
Precisely. People can simply forget details, misstate facts, or even intentionally mislead the auditor. Therefore, oral evidence almost always requires corroboration by more reliable forms of evidence, like documentary evidence or external confirmations. You wouldn't, or certainly shouldn't, base an entire audit opinion solely on, well, Bob in accounting said this big account balance was definitely correct. You need more proof. Beyond this main hierarchy, other factors also influence reliability. Documentary evidence is generally more reliable than oral evidence. A written record, especially if it's formalized like a contract or an invoice, is less prone to misremembering or misinterpretation than something just spoken. Original documentation is generally more reliable than photocopies, faxes, or documents that have been converted to electronic form, like scanned PDFs. Why? Because copies or electronic versions could potentially be altered, or they might lack certain security features present in the original document. If an auditor has to use such forms, they may need to perform additional procedures to confirm their reliability, maybe tracing them back to original physical copies if possible, or verifying electronic checksums for digital files to ensure integrity. Also, consistency of evidence. This is a big one. When audit evidence obtained from different sources using different procedures is consistent, it provides a much greater degree of assurance.
Everything points the same way.
Exactly. If the bank confirmation, the client's internal cash ledger, and the internal bank reconciliation all consistently show the exact same cash balance down to the penny, that consistency significantly boosts your confidence in the accuracy of that cash balance. Conversely, inconsistencies or doubts about the reliability of audit evidence, those are red flags. They always require additional audit procedures to resolve the discrepancy. You can't just ignore contradictory evidence, you have to figure out why it doesn't match. And finally, a point about information produced by the client. Even if it's internal information, like a system-generated report, if the auditor intends to use that information as part of their evidence, say, relying on an aged accounts receivable report generated by the client system, additional procedures are necessary compared to just using purely external evidence. The auditor has to actively determine its reliability by, first, obtaining evidence about its accuracy and completeness. This might involve testing the controls over the preparation and maintenance of that specific information, like verifying who has access to the system that generates it, what steps are taken to ensure data integrity during processing. It also means tying the information back to the original internal or external sources, making sure a report total agrees to the general ledger, or tracing a specific data point in the report back to an original invoice or maybe a bank statement. They might also need to validate the search criteria used to generate a system report to ensure the report includes all relevant information and nothing irrelevant.
Checking the recipe for the report, basically.
Checking the recipe, that's a good way to put it. And second, evaluating whether the information is sufficiently precise and detailed for the auditor's specific purposes. If the report only provides summary data when the auditor needs detailed transaction data for testing a particular assertion, then that report, even if accurate at the summary level, might not be appropriate for that specific audit procedure.
Okay, so reliability is all about the quality, the source, the trustworthiness of the evidence. Makes sense. What about the other pillar of appropriateness, relevance? Does it just mean it has to be generally related to the audit, or is it more specific than that?
It's much more specific than just being generally related. 3.5 relevance of evidence, does it even apply, means the evidence must directly relate to the specific financial statement assertions under consideration, and the time period must be consistent with the audit period. Now, financial statement assertions. These are basically the claims management implicitly makes about the numbers and disclosures in the financial statements.
Claims like?
Claims like assets reported on the balance sheet actually exist, or that all transactions that should have been recorded are recorded, that's completeness, or that items are valued correctly according to accounting principles, that's valuation, or that the company actually has the rights to the assets it claims and owes the liabilities it reports. There are several key assertions. Let's use that great illustrative example from our source again. Accounts receivable confirmations, sending those letters out to customers. They are highly relevant to the existence assertion for receivables. Why? Because if a customer confirms they owe money to the company, that's strong evidence that the receivable actually exists.
Right. The debt is real.
The debt is real. However, that same confirmation is not necessarily relevant to the valuation assertion for those receivables.
Why not? The customer confirmed they owe it.
Because a customer can confirm they owe the money, but that tells you absolutely nothing about their ability or willingness to actually pay it back. The customer might be on the verge of bankruptcy, for example. The confirmation doesn't address collectability. For testing valuation whether the receivable is likely to be collected, you'd need different evidence. Things like looking at an aging schedule of receivables, how long have these balances been outstanding, analyzing historical collection rates for that customer or similar customers, or maybe reviewing an analysis of the customer's current creditworthiness. So you see, the evidence must speak directly to the specific claim, the specific assertion you were trying to verify. Relevance is about the connection between the evidence and the assertion. Furthermore, when designing audit procedures, auditors need to consider relevance in terms of the design of the audit procedure itself. Is the procedure specifically designed to test the assertion directly? And is it designed to test for, say, understatement, like ensuring all liabilities are captured, or overstatement, like ensuring assets aren't inflated specifically?
Tailoring the test to the risk.
Tailoring the test precisely. For example, if you're worried about unrecorded liabilities, things the company owes but hasn't put on the books, you design a procedure that looks for items not yet recorded, maybe by reviewing cash payments made after year end. You wouldn't just focus on confirming the liabilities already listed. And also, the timing of the audit procedure. When the procedure is performed can significantly impact its relevance to the financial statement period being audited. For example, if you're testing inventory balances at year end, observing the physical inventory count taking place precisely on December 31st is much more relevant to the year-end balance than observing it back in September. If you observe it in September, you then have to perform additional, often complex, procedures to account for all the inventory purchases and sales that happen between September and December 31st to get comfort over the year-end balance. This really emphasizes the highly intentionality behind audit procedures, doesn't it? They are not random checks. They are carefully, deliberately designed to address specific risks and specific assertions, ensuring that the evidence gathered actually answers the precise questions the auditor needs to resolve to form their opinion.
Concluding the audit, tying it all together, and facing human factors.
Okay, we've covered a lot. What audit evidence is, its different types, where it comes from, and these crucial pillars of sufficiency and appropriateness. It's clear that gathering evidence is this complex, multifaceted process, much like a detective diligently collecting clues and evaluating their worth. So how does an auditor actually bring all of this together at the end? How do they synthesize everything to form a final conclusion? And maybe importantly, what happens when things don't go as planned? When evidence contradicts itself or when unexpected issues, like maybe even fraud, are discovered?
This is exactly where the auditor synthesizes all that gathered information. It's where they make the critical judgments that ultimately influence the final audit opinion. It really is the culmination of all the investigative work, and it's a true test of their professional expertise and skepticism. So let's look at 4.1 results of further audit procedures, the ripple effect. The information obtained from all those ongoing audit procedures we discussed. It's not static, it's dynamic. It feeds back into the audit constantly and can significantly impact the direction and scope of the audit. As new evidence comes in, it's continually evaluated, and it may lead the auditor to do several things. Reassess the risks of material misstatement. For example, if tests of controls reveal that a critical internal control isn't working as expected, maybe approvals for large purchases are frequently being bypassed, the auditor might have to reassess the risk. They might conclude the risk of errors going undetected in the purchasing process is actually higher than they initially thought, and that means they need to adjust their audit plan, likely doing more substantive testing in that area.
The plan has to adapt.
The plan has to adapt, exactly. The evidence might also lead them to identify control deficiencies. These are specific weaknesses found in the company's internal control system. Finding these indicates a higher likelihood that errors could occur and not be prevented or detected by the company's own systems. These need to be evaluated and often reported to management and those charged with governance. And, of course, the procedures might lead them to identify actual misstatements. This is when the auditor finds concrete errors in the financial figures themselves as a direct result of their substantive procedures. For instance, discovering a calculation error in how depreciation was recorded, or finding that a significant revenue transaction was recorded in the wrong accounting period. And this ties directly into 4.2. Revising the assessed risks of material misstatement. Audit evidence is truly dynamic. It constantly informs and potentially modifies the auditor's initial risk assessment. For example, if the results of those tests of controls indicate that controls are not functioning effectively, maybe worse than initially anticipated, this will naturally result in a higher assessment of the risks of material misstatement for the related accounts or assertions. In response, the auditor must modify their planned audit procedures accordingly. This often requires performing more extensive and perhaps more reliable, think external versus internal, substantive procedures to compensate for those weaker internal controls. If the security cameras are broken, as we said, the security guard needs to start doing more frequent manual patrols, right? Same idea.
So if an auditor finds big errors that the company's own controls completely missed, that's a huge red flag, isn't it? It suggests the controls aren't working. And what if something even more serious, like actual fraud, is discovered? How does that change the whole game plan for our financial detective? Does it just blow everything up?
Absolutely. It's a very serious matter indeed. Material misstatements that are discovered by the auditor during substantive procedures, which were not detected by the entity's own internal controls. Those are considered a significant deficiency or potentially even a material weakness in internal control.
That sounds bad.
It is bad. It means the auditor has to fundamentally change their judgment regarding the overall effectiveness of the company's internal control system. And they have to significantly revise their assessed risks of material misstatement, likely upwards. It signals that the foundational controls designed to safeguard financial reporting might be failing. It's like finding a major structural crack in a building during an inspection. You can't just ignore it. And if fraud is discovered, the auditor should never assume that an identified instance of fraud or error is just an isolated occurrence, a one-off mistake. Instead, they must critically consider whether that instance affects the broader assessed risks of material misstatement across the entire financial statement. Fraud, even a seemingly small instance, can indicate a much more pervasive control weakness, maybe a breakdown in management oversight, or perhaps a cultural environment within the company that might facilitate further misstatements.
The tip of the iceberg, potentially.
Potentially the tip of the iceberg. This requires a fundamental shift in the audit approach and a significantly heightened level of professional skepticism. The detective must now seriously consider that the crime might be part of a larger, more elaborate scheme. And a crucial reminder here, which we mentioned earlier but really bears repeating in this context. All audit evidence should be considered by the auditor, regardless of whether it is consistent with or contradicts the relevant assertions in the financial statements. This speaks directly to the auditor's required impartiality and their commitment to obtaining a full and objective picture, without just cherry-picking the evidence that happens to fit a preconceived notion or an easy conclusion. This leads us logically to 4.3 judgment on sufficiency and appropriateness, the auditor's final call. Ultimately, after all the evidence is gathered and evaluated, the auditor uses their professional judgment to conclude whether enough appropriate evidence has been obtained to support their opinion. This isn't a purely mechanical process with a simple checklist. It requires careful deliberation and the weighing of all the relevant factors. They consider things like the achievement of audit objectives. Have all the specific audit goals for each significant financial statement assertion actually been met? Have they gathered enough good quality evidence to say, with reasonable assurance, that cash exists, sales are complete, expenses are valued correctly, and so on? Their initial risk assessment and any revisions. How does the evidence gathered align with or perhaps modify their understanding of the risks they identified at the very beginning of the audit? Did the evidence confirm the risks or reveal new ones? The significance of uncorrected misstatements. Auditors will almost inevitably identify some misstatements during the audit, some small, some may be larger. They must evaluate these individually and also in aggregate, added together. And importantly, they also have to consider the possibility of further undetected misstatements lurking beneath the surface. Even small errors, when added up, can accumulate to a material amount that could mislead users of the financial statements.
Death by 1,000 cuts, potentially.
Potentially, yes. They also consider the effectiveness of management's responses and controls. How well did the company's management respond to audit inquiries or identified issues during the audit? Are their controls designed effectively on paper, and were they actually operating effectively in practice to prevent or detect future errors? Experience gained during previous audits. That prior knowledge of the client and its systems, its management, its industry can significantly inform the current judgment, providing valuable context. The results of all audit procedures performed. This includes procedures from the financial statement audit itself and, if it's an integrated audit, common for public companies, from the separate audit of internal control over financial reporting. This includes considering whether any instances of fraud or significant error were identified during any phase, and finally, their overall understanding of the entity and its environment. This is the holistic view, including the applicable financial reporting framework, like U.S. GAAP or IFRS, the accounting rules the company follows, and the entity's system of internal control as a whole.
You mentioned considering all evidence, even contradictory evidence. Our source really emphasizes this, saying auditors shouldn't ignore conflicting information. In fact, it says they should actively work to reduce instances where they fail to consider it. Why is that so important? It seems like it would actually make the job harder if you have to actively grapple with conflicting data points.
That's a great observation, and it cuts right to the heart of maintaining objectivity and professional skepticism, which are absolutely paramount in auditing. 4.4, contradictory and the supporting information. The full picture highlights that auditors must take into account all relevant audit evidence obtained, regardless of whether it corroborates or contradicts the assertions in the financial statements.
Yeah.
It's about being attentive, being thorough when weighing evidence, and actively working to reduce those instances where, maybe unconsciously, they fail to consider contradictory evidence. Now, it might seem to make the job harder in the short term, yes. It's easier to build a case when all the evidence points neatly in one direction, but ignoring conflicting information would completely compromise the integrity and the reliability of the entire audit. Think about it. A good financial detective doesn't just ignore a witness who contradicts the main suspect's alibi,
Who
do
there
they?
dig into that discrepancy?
They dig into it, they investigate that contradiction further. Contradictory evidence should always be documented meticulously by the auditor. Its discovery often leads directly to the need for additional audit procedures and obtaining more persuasive evidence to fully resolve the discrepancy. It's a key part of professional skepticism. Rather than dismissing information that doesn't quite fit a neat narrative, a skilled auditor sees it as a signal to dig deeper, to ask more probing questions, and to find the underlying truth, even if that truth is uncomfortable or complex. This relentless pursuit of clarification, of resolving inconsistencies, is fundamentally what makes an audit opinion credible and trustworthy.
This is really fascinating because even with all these rules, all these procedures, rigorous processes, auditors are still human beings, aren't they? Our source highlights something called auditor bias and gives some great examples of how it can creep in. How can human bias affect something that's supposed to be so objective and data-driven? It seems counterintuitive.
It does, but this is exactly where critical thinking becomes absolutely essential, and it's a vital consideration for anyone trying to rely on an audit opinion. 4.5 Impact of auditor bias. The human element in judgment acknowledges that when evaluating the results of audit procedures and the information obtained as audit evidence, the auditor must be acutely aware of potential biases, both unconscious and conscious, that can impact their professional judgment or their ability to maintain that crucial professional skepticism. These biases are, to a large extent, inherent to human cognition. How our brains work. Auditors are not immune just because they're professionals. It doesn't necessarily mean an auditor is doing something wrong intentionally, but rather they're part of how our brains naturally process information, often using shortcuts. Examples of potential auditor biases, which the source highlights, include things like availability bias. This is the tendency to place more weight on events or information that are more recent, more vivid, more easily recalled, or just top of mind. For example, if an auditor just finished dealing with a major inventory fraud at another client last week, they might be unconsciously overly vigilant for inventory fraud at their current client, even if the actual risk factors aren't strongly present there, because that previous experience is so readily available in their mind.
Seeing ghosts from the last case.
Seeing ghosts, exactly. Then there's confirmation bias. This is a really powerful one. It's the tendency to seek out, interpret, and favor information that confirms one's pre-existing beliefs or initial conclusions, while giving less consideration to alternative possibilities or contradictory evidence. If an auditor initially forms a belief that a certain internal control is effective, they might unconsciously pay more attention to the evidence supporting that belief, and maybe downplay or explain away evidence suggesting otherwise.
Looking for proof you were right all along.
Subconsciously, yes. Overconfidence bias. This is the tendency to overestimate one's own ability to make accurate judgments or assessments. An auditor might become too confident in their initial risk assessment, or maybe in their ability to spot misstatements just by gut feel, leading them perhaps to reduce the scope of their procedures prematurely, thinking they've got it covered when maybe they don't. Anchoring bias. This is the tendency to use initial information received as an anchor or a fixed reference point, against which all subsequent information is then assessed. For example, if management provides an initial estimate for a complex valuation, say, the fair value of a recent acquisition, the auditor might unconsciously anchor their judgment to that initial number, making it harder to objectively assess other data points that might suggest a significantly different, perhaps lower value. The form number sticks.
Hard to shake that first impression.
Very hard sometimes. And automation bias. This is an interesting one, especially relevant today. It's the tendency to over-rely on or excessively trust information generated from automated systems, regardless of other circumstances, or potentially contradictory information about the reliability of that system or its output. In an increasingly automated world, auditors might place too much faith in system-generated reports, assuming they are inherently flawless, even if there are red flags or valid reasons to question the underlying data integrity, the system's programming, or its controls.
Trusting the machine too much.
Trusting the machine too much, potentially, yes. These biases and others highlight that auditing, despite all its rigor and structure, is not purely mechanical. It involves significant human judgment at almost every step. Professional auditors are trained to be aware of these cognitive pitfalls, and good audit firms employ various techniques to mitigate them. Things like requiring independent review of critical judgments by another partner, fostering a strong firm culture that emphasizes and rewards skepticism, using decision aids or frameworks, and continually encouraging auditors to question assumptions and challenge management assertions. It's really about being aware of one's own potential blind spots and actively building safeguards into the audit process itself. And finally, after all that work, we come to 4.6 documentation requirements. The proof is in the paperwork or digital files. The entire audit process, from the initial planning right through to the final conclusion, must be meticulously documented. Now, this isn't just, busy work or some bureaucratic hurdle auditors have to jump through. It's absolutely critical. It's the official, legally binding record that provides clear proof of the audit work that was actually performed. And, crucially, it documents the basis for the conclusions reached and the final opinion issued in the audit report.
If it wasn't written down, it didn't happen.
That's the mantra in auditing. If it wasn't documented, it wasn't done. The documentation is the audit trail that supports everything the auditor claims to have done and concluded. Key documentation, the kind of things you'd find in audit work papers, includes the overall response addressing the assessed risks at the financial statement level. This shows how the audit strategy was designed to tackle the main risks identified and how the auditor planned their overall work accordingly. The nature, extent, and timing of the further audit procedures performed. This details exactly what tests were done, how much evidence was gathered for e.g. sample sizes, and when specific procedures were performed during the audit timeline. The linkage of those specific audit procedures with the assessed risks at the relevant assertion level. This is critical. It demonstrates that the tests performed directly addressed the specific risks identified for specific financial statement assertions. For example, if inventory existence was deemed a high risk, the documentation clearly shows robust physical inventory count. Observation procedures were performed and linked to that risk.
Connecting the dots.
Connecting the dots, exactly. Making the logic clear. Also documented are the results of the audit procedures, clearly outlining what was found, whether it confirmed the balance, identified an error, or raised further questions, and detailing any follow-up actions taken. Conclusions reached regarding the use of prior period audit evidence in evaluating the current operating effectiveness of controls. If the auditor is relying on testing done in previous years, they need to document why that reliance is still appropriate this year. The basis for not using external confirmation procedures for accounts receivable, if that balance is material. As we discussed, external confirmations are usually standard for material receivables. If an auditor chooses not to use them, they must clearly document why and justify the alternative procedures they used instead to achieve sufficient appropriate evidence for existence. This ensures transparency and accountability for deviating from a standard practice. And finally, a demonstration that the information presented in the financial statement agrees or reconciles with the underlying accounting records, including all the important disclosures in the notes. This is the ultimate proof that the final financial statements accurately reflects what's in the company's detailed books and records, and that the auditor's work successfully connected all those dots.
Wow, okay. What a deep dive that was into the world of audit evidence. Seriously detailed. We've seen how auditors meticulously gather and evaluate all this information, from the fundamental building blocks of basic accounting records all the way to independent external confirmations, and how they're constantly balancing the sheer quantity of evidence needed with its inherent quality and its relevance to the specific risks. It's truly a rigorous, often painstaking process.
You've really explored that intricate dance between sufficiency and appropriateness, haven't you? And hopefully, you now have a better appreciation for how crucial professional judgment and professional skepticism are in this field, a field designed ultimately to provide trust and transparency in financial reporting for everyone who relies on it. It's not about achieving that impossible absolute certainty, but about building a robust, persuasive case based on solid evidence. Not just collecting data randomly. It's really about creating credibility for the financial information that underpins so many critical decisions in our economy and society.
Absolutely. And thinking about all the complexities we've discussed today, the different types of evidence, the critical evaluation of their reliability, the hierarchy, the need for relevance, and even those very real human elements of judgment and potential bias involved, it truly makes you appreciate the rigorous, often challenging process behind that auditor's stamp of approval you see on financial statements. It's clearly far more than just a rubber stamp. It really is the end result of diligent, evidence-based financial detective work.
And this brings us to a final, important question for you, our listener, to perhaps ponder as you go about your day, looking towards the future. As technology continues to evolve at this incredible pace, think about things like artificial intelligence, potentially assisting in complex data analysis, or blockchain technology creating immutable, decentralized ledgers, or even more automated business processes where algorithms are making significant business decisions with minimal human intervention. What new kinds of challenges might auditors face in obtaining that sufficient appropriate evidence in the future? How might the very definition of what constitutes reliable evidence or even observable evidence shift in a world increasingly driven by decentralized, immutable digital records, or by complex algorithms making key business decisions without a traditional human paper trail? Will the auditor's role as that financial detective meet completely new tools, perhaps vastly different skills, and maybe even a fundamentally new mindset to navigate this future landscape?
Definitely food for thought. A lot to consider there. Thank you so much for joining us on this deep dive. We hope you feel much more informed, maybe a little less intimidated by the term audit evidence, and perhaps even a little bit inspired by the diligent, detailed work that goes into ensuring financial integrity in our complex world.
Until next time, keep digging deeper into the knowledge that matters.